you gotta chase after it. I'm gonna make another analogy. Be Pepe Le Pew.
Hey everyone, welcome back to Do What You Can for the People, the show that nobody asked for. I'm here today with my good friend Sahana Zutshi. She is a finance wizard, a fellow Bardian, my favorite bubble tea aficionado, and one of the most generous and kind souls I have ever had the pleasure of knowing. I'm so happy to have Sahana on the show today to talk about financing your startup. Hey Sahana.
Hi, Nicole. Glad to be here. Thank you for giving me the chance.
Thanks so much for being here. I was a little bit hesitant to talk about this because I'm not a finance person, so I'm really happy you came on this show because I think that this conversation about understanding financial options is so important. And so I thought we could start today by just kind of talking about why it's so important to understand all of your options, especially in today's day and age, and especially if you're an entrepreneur with a startup. So traditional bank loans for small businesses have generally been tough to obtain. Recent market trends have actually made it even more difficult for new startups to get the funding that they deserve. And there are a few barriers that entrepreneurs face in accessing capital. So I'm going to quickly run through these. Sahana, please chime in at any point with your expertise. The first is the disappearance of community banks. So small community banks were and are generally more willing to take a chance on budding business owners, but they've actually been declining in numbers since the recession of 2008. And larger banks have started swallowing them up, which is really sad to think about. And the larger banks are not really willing to make loans under $100,000 because it's not profitable for the banks, which hurts the average startup founder because they don't generally need that much money. They need quite a bit less. Correct me if I'm wrong on anything here so far.
So far, you are 99% and batting. Mix those two, but you got what I mean.
Another barrier that entrepreneurs face is the rise of service-based businesses with no collateral. So I face this. I have a service-based business. I'm a consultant. I don't have any collateral. I'm fairly certain that the big banks aren't interested in my costume jewelry collection or like my laptop. Like that's not worth anything to them. And so if you have a service-based business, it's difficult to prove that you have assets and that you're less risky, which a lot of big banks need that in order to give you money. And then I think the last barrier that entrepreneurs face is venture capital is focused on high growth potential. And so when you're just starting out, it's hard to prove that you have that high growth potential. VC firms, they can help founders achieve astounding growth, but it's a very small percentage of them. And they're so focused on having those numbers already that if you are really truly just getting started out, it's difficult to actually capture the attention of a venture capitalist.
Yep.
And then I think one other thing that we wanted to talk about today was how access to funding is not equitable, right? So among startups that do receive that coveted VC funding, in 2016, a survey was done where more than 3/4 of them were located in California, Massachusetts, or New York. And almost all of them were founded by white males. Women and founders of color received less than 2% of funding that year, which kind of ties into the theme of this season of my show, talking about privilege. And I know Sahana has some thoughts on that.
I do. When you said that less than 2% of VC recipients are women and people of color, I was like, this is my shocked face.
So can you explain to me why, because I was very shocked about that. Why were you less shocked? And maybe it's because of your insider knowledge.
No, I mean, yes, a little. And it's also, you know, where the VC unicorns really are. It's mostly Boston, it's mostly California, to some extent it's New York. And a lot of the people who can tap into the networks that they have, which allows them to get the VC attention, some of them are driven by schools. A lot of them are driven by, you know, who your friends are, who your parents know. Warby Parker, for example, was a UPenn-based business, and they raised all their money from the UPenn alumni network. And of course, they were all white men. So unfortunately, because of structural inequality, even the networks that we have access to are very heavily skewed in a certain direction, which is white male, and then the second tier is white female. So, and the beauty of diversity that comes from having people of color, that comes from having women in the experience, that's not something that has really been on the VC's radar up until very recently. So I would say over the past year, 2 years, after a few impact funds have really shown their mettle about how these businesses are less risky than first assumed and much more profitable than first assumed, it's not something that VCs have really looked at. And the second thing is that a lot of VCs right now are still very tech oriented. So again, then you have Silicon Valley, which goes to California, which taps into the college network. So it's a lot of like, when you are starting your firm, what access do you have to even build your model? And that is very heavily skewed against low-income community, people of color. So once you build your business model, once you build your product, it's the second step is how you reach out to the venture capital. Again, because of structural inequality, your pool is very limited. So I wasn't shocked. I was shocked that it was 2%. I thought that it would be maybe 5 to 6%, but I wasn't shocked that it's like the majority white male.
Yeah, I don't think anything being a majority white male really shocks me anymore, but that 2% number, it did seem significantly lower than what I would expect, especially coming from someone who's always been very entrepreneurial. And I see so many, especially female entrepreneurs out there. And my network, and this is probably because it's my bubble, tends to be a lot of women of color entrepreneurs. And so just knowing how many badass bitches are out there building their own businesses, it's shocking to me that they have captured such a small percentage of the financial opportunity out there. And I think that's what really I wanted to get into in this episode, is kind of like, how do we, because I'm not particularly financially literate. Like, I've started multiple businesses and I couldn't tell you how to fund things myself. I just put my own money into it, which is always an option. But I think it's important, especially for women and women of color, to understand what their options are beyond just pouring their own savings in there, which in itself is a privilege, I think.
Yeah, very much so. I know that a lot of people talk about bootstrapping, but then it's like there's a difference in terms of your network on how much you can bootstrap, you know. For example, like we said, like for a UPenn network, the amount of bootstrapping you can do, 20 million right off the bat. My sister, she goes to Harvard Business School. She was talking to somebody in her network, and you know, not about starting a business, but they were like, "Oh yeah, I'm talking to this business, and I can easily give them 10 million." So that kind of bootstrapping is a little different than, you know, if you are originally from a low-income community and you can't really ask your friends and family for even $1,000 to $2,000 because they need it to pay rent. So VCs, I'll be totally honest, I am not a huge fan of venture capital right off the bat in terms of entrepreneurial financing. I do think that there are options out there for people. Community banks, like you said, they are dying, but credit unions are actually hidden gems. A lot of people don't think about them. They automatically think about the big banks. But credit unions are in a lot of ways much safer just because by their own nature, since they have a lot less risk in terms of systemic risk versus big banks, they're willing to, especially if it's a credit union in your neighborhood, they're willing to take a chance on a small entrepreneur, especially if they have a good business plan. So before you start anything in terms of where you're going to go for financing, I would say approach your business plan and approach how you are starting your business like a war campaign, or maybe a war campaign isn't a good word for it, but a campaign of, you know, logistics, supplies. My rule of thumb is like, if you're asking for a certain amount of money, try to make a billing statement of everything that you think you need, then add 20% of on top of your expenses, then add an additional 20% on top of those. So whatever number you have, try to go 40% over in terms of the financing or expenses you'll need. And when you are thinking about the revenue you're going to get in, it's the same rule of thumb, 40% less than what you'll be getting in the first 1 to 5 years. That should give you a good idea of the reality, because human beings tend to undersell the expenses and oversell the revenues. So once you have that in mind, and you have a better idea of what your expenses are going to be, then you have to start figuring out the next step, which is, are you comfortable with taking equity, or would you prefer loans? Both are good, both are bad. Equity in terms of venture capital, the thing that really gets me about venture capital is that they tell you that they have minimum 10-year plans for you. Most venture capitals will not go 10 years with you. They look at you with a 1 year, 2 year, 5 year basis. And if you're not making profit by, like, say, year 3, they tend to kind of dump you. Yeah, so venture capital is kind of toxic if you don't have uh, that backing and a fallback. So with regards to venture capital, you have to be like, where am I going to be 1 to 3 years from now? And that's where the seed funding also comes in, because the amount of capital you're going to get is also dependent on where you are in the process. So should we talk about seed funding right
Yeah,
now, or okay?
let's go through it. So Sahana kind of wrote up in our little notes document the traditional stages of funding, and I think this is really important for anyone to know. And so we've talked a little bit about pre-seed, talked a little bit about seed, but why don't you walk us through some of these more formal thoughts that you have?
Okay, so the seed funding is really the equity stage, this is when you are selling off percentages of your idea. So this is when your venture capital or your angel investors, not so much angel investors because they're a little better than that, but generally investors, this is when they have ownership of your idea. And that depends on the contract you're setting in. Do they get 1%, 0.5%? How much is one share of the idea? So that's up to you to draft that contract. And for anyone out there who is beginning to look at a contract with a VC firm, I would say that there are a lot of pro bono lawyers out there. And if you're not comfortable with pro bono, spend the money to talk to an actual lawyer to make sure that that contract is in your favor and not in favor of the VC firm. It makes such a difference. So once you do that, your seed funding is basically series A, B, C, and D. So Series A is after pre-seed. It's like you've established a time period of success. You've started your product. You are like maybe 6 months in, and your time period of success is a year to 2 years. And this is basically your business model is semi-successful, and you're looking to scale up to drive profits. That's Series A. Series B is you're past your development phase. You've scaled up the business. You're on maybe you're on Costco or Walmart and stuff like that, and you're focused on growing the company to meet the demand. So this is where you've proved that your product has viable demand. The demand is growing past what you can supply, and you're getting additional money so you can meet the growing demand. A lot of people in Shark Tank, a lot of the entrepreneurs who come on Shark Tank are typically in this Series B stage, in which they've proven the viability of the demand for their products, and they're looking to basically expand their operations so they can meet that growing demand. So Series C is your business is not IPO'd, but you are successful and you are looking to either develop new products, expand into markets, and if you are a bigger company, slightly bigger, you can acquire a smaller company. So this is like, you're on the shelves of Walmart, you're on the shelves of Costco, but you're looking to develop new products. You are looking to go past that one trick pony stage, or you're successful in the US and you're looking to move on to Mexico, Canada, China, what have you. So this is where you grow the funds for a Series C funding. And the last one is Series D. And this is basically like, it's at the behest of management at this point. It's what do your board of directors think you need as a final push before you go to IPO? Or what do you as founders think you need as a final push before we go to IPO? So think of what did Uber do with their final Series D to make themselves look more attractive before they IPO'd. It's the Series D is your playground. It's whatever you think will make the company successful after you launch to the public.
Super helpful.
Yeah.
For those who don't know, IPO is initial public offering.
Yes.
And that's when you can like buy stocks of a company. I'm wondering if there's a final stage without going public.
You can stay private, but like again, that depends on the contract that you've signed with the venture capital firm.
Got it.
So if you have enough funds at the Series D stage that you can buy out the majority of your stakeholders, so you and however many people you started the company with can retain the private shares, then you can keep the company private. But at that point, it's just like what was written in the contract, what is your VC asking for? Because a lot of times venture capitals make money based on going public, right? So if you don't want to, then that is a negotiation you're going to have with the people who have put money in, and
Beforehand.
yeah, 9 times out of 10 you have to pay them back somehow with interest, just because they've put the money in. But if you have that money, you should you should go for it. It's just a comfort level. Some people like to go public. For them, it's like the dream. Others like to stay private. So
Super helpful to even just understand how that works in a venture cap. You know, people always talk about, oh, VCs, oh, Shark Tank, oh, this, but like what actually happens behind the scenes and what you need to do to prepare for that and how it will progress and what the expectation is. I think it's so important to understand if you're even considering that route. It's not just that you get money. There are serious implications. And I think we're going to get into this a little bit later about the advantages of having a VC investor and giving out equity as opposed to keeping all of the control yourself. And we could talk about that a little bit later. What I really want to get into are all of these amazing non-traditional sources of funding that you listed. Creative and so interesting to me as someone who is leagues away from approaching a VC.
oh boy. Yeah, I mean, the thing is that because I honestly think it's partly because there's so much of a VC hype and so much of a get your angel investor hype from Shark Tank that people are a little hesitant to look at more traditional sources of funding, or I should say non-traditional, because VCs have now become traditional sources of funding, or they're not sure of the risks attached or how much more work they'd have to do with non-traditional sources. So I'm definitely going to say that it is work. It's not easy, but if you love your business, if you're starting as an entrepreneur, you're pouring your hard work, sweat, tears into it. Taking that extra step is something you're just going to have to psych yourself up for. So
Yeah.
The amount of non-traditional avenues open to you are also dependent on where you are as an entrepreneur. So if you are, say, like a traditional entrepreneur, you want to open a restaurant, you have the physical assets, you can go to your community banks. You can also go to credit unions. You can also reinvest if you are making a profit into your own business. These three are very traditional sources. If you want to go to banks, there are for big banks there are small business association loans. These are this is a government initiative, and I think because of COVID and the PPP, Payment Protection Act, this is something that has a lot of liquidity right now. But the thing with this is, especially for larger banks, they put in their own rules and restrictions. And a lot of times, especially if you are a new entrepreneur, it's your first business, the collateral is often your own house or your business assets. So you have to you have to sit down and think, is that what I want to put in with regards to this business? If it's I would say if it's like a sort of traditional business and you kind of know the neighborhood, you're kind of guaranteed your success. What's your risk tolerance with regards to that? But if you're starting something new, like you said, Nicole, a very service-based business, then you have to really think, what is my risk tolerance? Because then it comes down to your personal assets and what you're willing to give in, not just your savings, but also your home, your equity, a lot of times your 401k, if you have that. So they go after a lot of stuff. But small business, these SBAs, the small business loans, are a lot of big banks have them, small community banks have them. I don't think credit unions have those in particular, because credit unions are a little more flexible in terms of the rules and regulations because they are credit unions and non-banks. So they're subject to different rules. But I would highly encourage anyone who's listening to this, see if there's a credit union in your neighborhood. see what their requirements are. Sit down and chat with somebody and, walk them through the process and be like, or have an informational interview. So it's a good avenue to explore, if nothing else. So those are for the traditional businesses. Now, if you have an idea, but not necessarily, all you have is kind of like the germ of an idea, there are accelerators that you can go to, and there are different levels of accelerators. So there are accelerator programs that are willing to give you the money to play around with your idea. Then there are accelerator programs that you have been in a lab, you have proof of concept, but you need to basically test it in a lab, in a larger lab setting before it goes to market. So a lot of times, especially with tech and sustainable accelerators. So if you have, for example, equipment that can selectively spray pesticides on plants. So
or like an innovative material or something
anything
like that.
Yeah. So you've tried it in a lab, it works, and but you need to, before you start selling it in the greater market, you need to have it tested across various iterations to show that it works repetitiously. Wells Fargo's innovation incubator is an accelerator that kind of gives you the money to $250,000, I think, to give you and expertise to give you that. But that's only if you have proof of concept. So that's an example of an accelerator that is, if you have proof of concept, they're willing to give you the money. It's not a loan, and it's not an equity-based funding, because that accelerator is nonprofit. But so you get the money. It's a grant. So there are even different accelerators with regards to, some accelerators give you equity, some accelerators give you loans. A lot of accelerators give you grants, but with accelerators specifically, it's a lot of times it's innovative and it's supposed to be disruptive. The document has a link of accelerators. The Boston Mass Challenge Accelerator is really interesting because they're, again, a nonprofit. You have to be based, I think, in Boston or around that area in general, though. But they have given, I think, over $5 billion of funding over the past few years. So yeah, when people have deep pockets, that's why a lot of accelerators, a lot of nonprofit accelerators really flourish in these cities, because the people have the ability to pour money in. So it's also a way for angel investors to give money to the accelerator, which has expertise, rather than doing it themselves. So those are accelerators. And I will say, shout out, if you have an idea that is education related or nonprofit related, there is, it has to be science-based. But if you are a woman or person of color with a science-based idea, there is the National Science Foundation. It is a great start. They give grants from $100,000 to $300,000, and those are grants. And this is one of the areas where you get a leg up if you're a woman or a person of color, and a really big leg up if you're a woman and a person of color. The only thing is that if your idea typically has to be science-based and shows some education or nonprofit benefits. So that's a shout out to those guys.
But there are a lot of like hyper-specific grants that are coming out, I think, for women and women of color. I've encountered a couple related to like the circular economy and stuff like that they keep coming across my desk. And so it's out there if you look for it. And so I encourage everyone watching to just do a Google search and see what comes up in terms of accelerators and grant programs and stuff like that, and just apply. You never know.
Yeah. I mean, I would say, apply, be vigorous. Don't make the assumption that just because you've talked to an associate at any of these things for 3 times, that's it. You gotta chase after it. I'm gonna make another analogy. Be Pepe Le Pew, chasing after his or her flame of the week, right? That's because you only need one, right? Once you get your foot in the door, you can use that to leverage for the rest of your pipeline. But you have to get that one foot in the door, because once you're in, then you build and build and build.
It's the snowball effect. Yeah, it's like also, if one person has invested in you, suddenly everyone else feels safer to invest in you. So
exactly. So the last, second to last thing I guess we should say is crowdfunding. And this has become really big because of the Obama administration and how it really opened sources of funding from non-accredited investors. Yeah. So before this, it was just accredited investors. That's where angel investors came in. That's where VCs came in. But during the Obama administration, they opened this door up to normal people like you and me, and we could start investing money in different funds. So one thing with regards to this is if you are looking at accredited investors, unaccredited investors, sorry, if one person invests in your company, the typical rule of thumb is they have to wait 6 months to invest in your company again. So if you are interested in seed rounds and how you're raising it, keep that in mind when you're building the timeline of when you are going to be raising your funds for your company. But there are various types of crowdfunding. WeFunder is actually something that was started by the government, and it is equity based. And WeFunder is really where you send people, where you put your idea out there. And the thinking is that they will give you the money and you can actually start creating your physical product and start your proof of concept. So if you are someone who has a fantastic idea, like biodegradable tennis balls, WeFunder is where you can go to start creating your proof of concept. You raise the money for your biodegradable tennis balls, and then you go to somewhere like a Wells Fargo or a Boston accelerator where they give you the money to go from proof of concept to some to market. So one source of funding is not the be all and end all for your entrepreneurial idea. You have multiple sources and multiple ways to go about it. So it's important to be flexible, not just with what you're creating, but how you're going to be funding it.
Yeah, I kind of think of it like a Sunday bar, like an ice cream sundae bar. Like
Yeah.
you can have multiple toppings. It's allowed.
Yeah. You can go back multiple times too.
There you go. Yeah, that's so true.
So VFunder is an example of equity-based crowdfunding. Then you have debt-based crowdfunding, like the Lending Club and Kiva. So that is typically you put your idea out there and you decide what interest rate you're offering, and then people buy debt in your company. They're like bondholders in your company. So depending on the contract that you've provided, you can give them dividends monthly, or you can basically hold on to the money and pay interest, repay the principal with the interest at whatever time period that you guys decide. So something like Kiva and the Lending Club are two examples of that. Then you have what I call rewards-based funding, which is basically like Kickstarter and Indiegogo. And this is where you have your product and you are basically trying to sell the idea and the concept of the product to people. And that's where Kickstarter comes in. You raise money for, you're like, this is my idea. This is the product. I've created the product. I have X amount of for this product, but I need the money so I can, start selling more, scale up. And that's where things like websites like Kickstarter and Indiegogo go and come in. Sorry. And the last one is donation based. The biggest is GoFundMe. The thing with donation-based campaigns is like 9 times out of 10 people are on websites like GoFundMe to help people in need. So if you're going in with your product and being like, I need donations to, create this product, you're not necessarily going to get a lot of money, but it should be said that it is an option. You should think long and hard about if you want to go there.
I think also important to note here is that when you're thinking about crowdfunding options, you really need to understand the audience. And this is, I think, where the marketing piece comes in. The type of person who is hanging out on WeFunder is very different from the type of person who is hanging out on Kickstarter. And depending on what your value proposition is, the person who you want to reach to fund you is going to be hanging out in a different place. And so think about your customer profile and what their values are and what they're hoping to gain out of funding your business. And from there, you'll find the right platform, I think.
Yeah, for sure. You need to know your investor. And I think, like you said, the values base is very important at this time, because are you looking for an investor that is long-term oriented? Are you looking for an investor who is okay with you taking back control of your, of your project?
Yep.
What are you looking for in terms of, because literally it's intimate in a sense, isn't it? Because you are giving them your idea, especially if it's equity based, and an idea is so much a part of who we are. If it's debt based, it's a different thing. You're giving them your money, you're giving them your life. But if it's equity based, you're kind of giving them your soul. So you better be sure about who you're giving life or soul to. So uh, I make weird analogies. I swear my financing is so much better than my analysis. So,
I think they're both excellent.
okay, so the last two, and I'll be done after this, I swear, are startup competitions, which everybody hates. But startup competitions are really good because, one, they're good networking. Even if you don't win number one place, the fact that you can talk to the judges and they can give you an idea of what your pitch deck should be like, which is great when you are pitching to banks, credit unions, and the like. It really gives, it's a good way to practice your pitching
Yes.
and everything else. And it's a good way to practice your networking. And it's a good place to just network. They're exhausting. I'm not gonna lie about that, but you have to pace yourself. You have to you have to have self-care, and just it's step one of like 1,000 steps, right? But you gotta go step by step. And the last thing is, if you are starting an entrepreneurial business, and but it's something that is in concert with something that is already being there. And if you're like, I want to be an entrepreneur for 5 years, and after 5 years I want to get a traditional job, then take a look at your idea and see if it is something that can have a synergy with an established company, and figure out if you can make a partnership there and create a contract in which after X amount of years, the other company can kind of absorb you and you can become a director. A lot of pharma startups do this. They look at where they have synergy with traditional companies, they grow the companies, and a lot of times that's when they get acquired by the big pharma.
Yeah.
So that's like, if you have a healthcare based startup idea, is where a lot of this goes. So that's it.
So helpful. I feel like a lot of these things are things that we know about. Like, we all know about GoFundMe. We all know about startup competition. Well, maybe we know about startup competitions. Maybe that's an MBA student thing. I don't know. But I think thinking about it in this lens of financing an endeavor that you're going on and looking beyond just taking out a business loan or putting in your own money, or, going after the VCs. And we're not saying that any one of these is wrong, but it's just important to remember that holistically you have a lot of options available to you. And the more you ask for money, I've found, the easier it gets to ask for money. So
yeah,
start when it's uncomfortable, because it's never going to not be comfortable to start. Like, it's never going to be comfortable to start. So just start.
No, yeah, no, 100%. I think, sometimes we take for granted the amount of information that is out there for us, because I think that not a lot of entrepreneurs, but if you are an entrepreneur from a low income community and you have an idea which you think is going to do great for your community, you are dealing with the fact that 9 times out of 10, you have a lot of things pressing on your time and you don't have time to do the research. So having something like this, I think, is a great idea, because this is like a 30 to 45-minute presentation, as opposed to an entrepreneur going out there trying to do his or her day job, the night job, and do all this research. So the information barrier is a real thing. And I think in the age of internet, people kind of take it for granted. But if you realize that there are communities out there that don't have an internet, you should not be surprised that there are people who don't have time to do hunting for information. So I think, you're doing a good thing here, Nicole.
Thank you. I'll be sure to include links below in the description box for all of the amazing research that Sahana did, a few small things that I found. And I just wanted to leave it with you, Sahana, in case you had any closing words for our lovely viewers.
I know that this is a really uncertain time, and if you're an entrepreneur, you're thinking, wow, what the heck am I thinking? Is this the time where I want to do it? But I would say that in terms of opportunity, it's really, part of it is luck, but another part of it is you forging the path you want to. If you think that the environment is bad, then you're going to run into obstacles. If you think that the environment is bad, but you're determined, I promise you, it might take 3 months, 6 months, it might take a year, but your perseverance will lead to opportunity. So it's, if you have a dream, then if nothing else, COVID should show us that life is uncertain and we should go for it.
Yeah, don't let your dreams be dreams.
Exactly.
All right. Thanks so much, Sahana, and to everyone watching. Come back next week for another episode. Bye.
Bye, everyone.